markets are crashing and gold, it's supposed to be our insurance, but it's crashing too. So in this video, I'm going to explain why this is happening. I'm going to show you 3 key points that history shows us from other market crashes, and it's also going to explain the best way that we should be playing this. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money, investing money, and just overall, general success stuff. So if you like those topics, which I'm sure you do, make sure to click the like and subscribe button so you're notified every single time I put a new video out. Now today we are talking about gold. It's supposed to be our insurance. Obviously the last couple of weeks the markets have been crashing, and I'm sure you know why. I'm not going to say it on this video. YouTube's not liking that for some reason, but the last couple of weeks we've seen massive carnage. We've seen massive red across all the different markets. As a matter of fact, we saw the largest single day drop in history of like 124 years or something like that. And so gold actually crashed as well. And gold is supposed to be insurance, right? So it's supposed to be non-correlated, uncorrelated. So if stocks go down, gold's supposed to be going up. It's supposed to be the safe haven asset. But what the heck's going on? Why did gold crash as well? And it's not just gold. Bitcoin, which is supposed to be the other safe haven asset, also fell as well. Now, I'm not going to get into Bitcoin. We're talking about gold today. But why did it fall when it's supposed to be a safe haven asset? And what does that mean for us? So let's talk about first why. Why do we think it fell? Well, probably what happened, most likely what happened, and I'm going to tell you why I think this, is that as stocks were getting pummeled, as stocks were getting pulled down, investors started losing a lot of money. Now, the majority of the market is made up by funds, hedge funds, pension funds, etc. And they use lots of like algorithmic trading, bots, they run off of technicals and things like that. And so when the market starts breaking down, more orders happen, more orders get triggered. Then people start getting liquidated very quickly. And so in order to make up the yield, because it's very hard to get yield, it's very hard to get good returns these days, all these funds are playing with massive leverage. And so what happens is when you're playing with leverage, now you have to cover your positions or you get completely liquidated out. So if you just put $10 in, you could write it down to $5. But when you're playing with leverage, you have to put more money in to keep your position or you get liquidated, meaning they take it all away from you. And so these funds, they need to get massive cash. They need to get liquidity so they can pump it back in so they can keep their position so they don't get taken away. And where do they get that from? Well, the best asset was gold. And gold is also the most liquid. You can put in billions of dollars of gold into the system to get that liquidity. And where do they do that? Obviously, you can't do that with physical. You can't get billions of dollars of physical gold, but with the gold stocks, the gold ETFs, etc., is the easy way to get that cash, which is why we saw the gold stocks get hammered the most. That's the likely reason why. Definitely not in the fundamentals. So all the fundamentals are still intact. Now, I've made a bunch of videos about gold, so I'm not going to go into all those fundamentals here. But of course, the big part is the central banks, the easing, the monetary policies, the printing of more money, $11 trillion that's been pumped in the system over the last 11, 12 years, on and on and on. You get the point. All those fundamentals are still intact. And so then the question is, if that's why they fell, the fundamentals are still intact, is this a buy the dip moment? That's a question I've been asked a lot lately, and so I wanted to make this quick video. So if they're all still there, is it a buy the dip moment? Well, what does history tell us? If you watch any of my videos, you know I'm always about history. I love to go back in history because I believe history doesn't always repeat, but it rhymes, right? And so if we go back in history, it gives us a really good idea of what could potentially happen in the future. And so what I did is I went back through history and I looked at all the past stock market crashes. All right, well, not all of them, but in recent history, I should say. And I measured gold and silver's performance during each one of these market crashes to see if there was any historical tendencies that we could get, that we could see. And when we look at all of that, going back to about 1976, as you can see here on the screen, in this table, it shows the 8 biggest declines in the S&P 500, a major index, since 1976. Now, it's important to look at since 1976 because that's when we went off the gold standard in 1971. So that's when the world changed. That's when things changed. So it's important to look at kind of more recent history. And when you look at these 8 biggest declines in the S&P since 1976, you can see how gold and silver prices responded to each one. And you can see on the chart that only in 1980 to 82 and 1998 did gold fall along with stocks. All right. Now, a lot of you might be going, that's not true. What about 2008? And I'm going to get to that. But I'm going to show you 3 points that this chart is telling us right here about what happened in the chart, but also about what's going to happen in the future. So the first point number 1 is that in most cases, gold actually rises. So as we saw on the chart, regardless of whether the crash was short-lived, whether it was stretched out over a couple of years, gold climbed higher, right? Either way. So gold even climbed in the biggest crash of all, which was, the great financial crash, 2007 to 2008. During that time, the market crashed over 56%, lasting years and years and years. And during that time, it looks on the chart that gold actually climbed. So history shows that gold rises in all but 2 of the recent history market crashes. Now, like I said, people are going to be talking about what about 2008. So 2008 was the most recent, most memorable market crash. And people say that gold fell, and they're right, it did. Gold actually fell in 2008, and that's why they think that gold's fallen again today. However, if you take a look at this chart that I put up on the screen right here, you'll notice that both in that 2007 crash, gold and the S&P both crashed at the exact same time. And over 7 months, the S&P fell 53% and gold fell only 25%. I mean, they're both bad, but if I had to choose one or the other, I'd rather lose 25% than 53%, obviously, right? But what's important to understand here is that gold recovered its all-time high or its previous high in only 7 months. So yes, it dipped, but within 7 months, it had reclaimed that back up. It took the S&P 57 months. That's almost 5 years. So yes, they both fell. Yes, the stocks were twice as severe, and gold recovered in 7 months versus 57 months that it took stocks. All right, so that answers about 2008. Now, point number 2 I want to make is that what this tells us is investors shouldn't panic over an initial drop in prices, right? That's the lesson that we can see here. So if gold initially declines during a market collapse like we saw in 2008, it usually bounces back really, really quick. So in fact, basically what this chart's telling us, what the graph is telling us, that when it dips during a crash, it's actually a great buying opportunity. So again, right, as it crashes, people need liquidity, they sell their gold. Then what happens is then all the fundamental reasons why we want to own gold start kicking in big time, right? So then let's get the money printing, let's get the easing, let's get the quantitative easing, all these things, let's drop interest rates, and all those things make gold rise really fast. So gold bounces back super fast and becomes a really good investment. All right, now the third point that I want to bring up about this chart is one that you may not like so much. All right, I made a video, silver's not what you think, and I got all the silver people coming out to make their case, and so let's go ahead and hear it here. Number 3, silver doesn't do so well. I said it. Sorry, don't come after me. And that's just what the chart tells us, right? So what we can see from this chart is that silver only rose in only 1 of the S&P sell-offs. So gold did good in all of them except for 2, kind of. Silver only rose in 1 of the S&P sell-offs. So it was basically flat in another one. And the reason why I think this is the case is because of silver's high industrial use. Now, again, back in the linked video here, silver's not what you think, I talked about that the reasons for silver and gold are different. I'm not saying silver's not a good investment. I think silver has definitely some speculative qualities. I think there's probably a lot of room for silver to run, but the reason why you buy silver and gold are different. They just are. And what I showed in that video is that estimates show that about 80% of demand for silver are industrial uses, whereas gold, it's mostly investor uses, right? So the reason why we see silver typically fall in a stock market crash is because stock market crashes typically are associated with poor, deteriorating economies, right? So for example, with the current problem that we have right now, most of China is shut down, right? And so the stock market is crashing. If the China manufacturing sector is shut down, that means like electronics aren't shipping. What material do they need in electronics? They need silver. Well, let's see. So if the market's crashing, no electronics being made, and there's no demand for silver, the price of silver goes down. That's why silver typically goes down with market crashes as opposed to gold. When market crashes, when the bazooka cannons come out to pump in liquidity, that pushes gold up. But the manufacturing goes down, which brings silver down. That makes sense? Now, for all you silver fans out there, there's good news for you. It did fall less than the S&P in most cases. So in most cases, it was a better place to have your money than the S&P. However, it didn't go up like gold. So again, what's the rhyme? What's history telling us? What's it echoing into the future? And basically what it's telling us is that gold holds up really well during market crashes. And so since 1976, through these 8 market crashes, gold has been a perfect asset to hold when stocks go down, right? And like I said, all the market fundamentals are still intact. We've already seen it. I think, was it just today, the Fed came out with an emergency meeting. They're not supposed to meet for several weeks. They came out and said, we're lowering rates. Like the Fed, the PBOC, all the central banks, they're already coming out with everything they got to put at this recession, right? They've been trying to fight this recession since 2011, for 11 years, since about 2008. They're not going to stop right now. They are going to continue to lower rates, devalue currencies, pump liquidity in the market. I was reading a report yesterday that the Fed appears to even be buying stocks right now. And so, again, those are all the reasons why we want to buy gold. So I think it's a buy the dip moment. What do you think? Leave me in the comments down below. Let me think. Is this the buy the dip moment or not? I think it's at least a wait and hold and see. So I think there's a lot of overreaction being done right now. Maybe things are going to be really bad, but maybe they're not. And so we're definitely in a wait, hold, and see situation. Or maybe to buy the dip. Now, I always say don't try to catch a falling knife. So we're not trying to catch it on the bottom. We're trying to wait for something to happen to prove our thesis, and then we go in. Now, as far as how are you going to play this, buying physical gold obviously is one way to do that. The preppers, end of the worlders, they think you need to hold gold in your physical location in your safe, because if the world comes in, you want to hold that gold. And there's definitely some truth to that. I do hold physical gold for situations like that. However, for a lot of investments, it makes sense to use gold stocks, gold mining stocks, etc., because the moves are so much more explosive. So that's a really good way to play this, especially if you have larger sums of money. Obviously, you wouldn't want to put $5 million of gold at your house. It would be very unsafe. Please don't try that. So you can do it through gold stocks. You can do it through gold mining stocks. And so the market for those is really, really small. And as gold continues to move up, I believe it's going to break $2,000. It'll break past the all-time high. And once it breaks past the all-time high, it's going to get a ton of attention and people are going to start piling into it. And on the gold stocks, especially gold mining stocks, the market's really, really small. And so you start getting people piling in and it can push those things up really, really, really fast. So that's my strategy. Let me know what yours is. Leave me a comment down below. Is it a buy the dip moment? And are you going to buy in physical gold or are you going to look at gold stocks? I'd like to know. Of course, I try to respond to every single comment down below. Of course, I always like it if you give me some thumbs up on this video or thumbs down if you don't like it, but it helps the algorithms and helps more people to see these videos. And that's it. That's what I got for you today. Buy the dip to your success. I'm out.